Hello, good afternoon, everyone. My name is Wei Chen, and AKA Wei Chen. So today I'm going to share with my 2 cents regarding to the current very hot topic for recession. So a lot of people currently is talking about whether the recession comes in and whether we're in good shape, what we are going to do if we have we have been prepared for a recession, what we are going to do for that. So, the purpose I'm going to present you is to make a friend, making some new friends and talk about, different opinions. So today I'm going to share my personal opinion on what I have heard, what I have learned, based on what I have known so far regarding to the current economy status. Um, for today's vlog, and this is my first time to record an English version. I try to explain to my audience, try to explain, my opinions to my coworkers, work, a lot of friends who don't understand, Mandarin Chinese. So today, I'm going to present a very short and brief introduction for my 2 cents first, and then I will go to the details, the charts and the data, and especially historical data, to see that what's going to happen and how can we prepare for that. And then I will do even some technical analysis in the charts. So feel free to contact me if you have any questions, any issues, if you have, if you have different opinions, that would be totally fine and totally awesome. And feel free to let me know. That's my purpose, is try to have another, a real channel to talk, my opinion in terms of economy and, finance with all my friends, no matter what you are working on, and no matter where you are from. All right, so let's begin. So first is that topics is recession coming, and then I will talk a little bit about who I am, and I'm just a personal investor, non-professional trader investor, and currently I'm trading and investing for fun and for making friends. So non-CFA and non-CPA, non-MBA. So actually, it's non-titled personal investor. So all my opinion, you will see that actually is amateur. It's not professional. So it's not a professional otherwise. So I just using this channel to make more friends, to share my express myself and express my personal opinions, and that definitely not going to make any profit or making money by doing this. Disclaimer is that since I talk a little about economy or even financial information, so the information I'm going to provide is totally for fun, for informational and entertainment purpose. So definitely not being considered as any kind of financial advices or suggestions, just like personal opinions and nothing from institutes. If you use my channel for any kind of trading or financial planning, you need to take your own risk because currently I'm just doing that for fun. You need to if you heard what I've said, if you need to confirm with your personal advisors, and then my point, my 2 cents just for myself. All right, so I talk a little about next step. So while I'm sharing my thoughts, I try to make more friends. I try to have, I want to make, I'm the person really like to share. I want to share more and I want to make more friends and enjoy my life. And if you have any different thoughts, if you have different opinions, I'm totally open. If you can talk with me, I do really, really, will, I do really appreciate that if you do that. If you don't want to share, totally fine. I just want to share what I have learned by recent years. Dun, 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 dun. Topics that we will cover is that is the recession coming or coming. If the answer is yes, is when that's gonna come. So that's probably probably, the more critical question is that when, because, we can say, oh, is recession coming? Probably can say yes, probably in 20 years. The percentage is about 100%. So, but the when, that's a really tricky question. So I think I try to answer that question myself. My 2 cents about trade war. Trade war currently is a very hot topic, especially from between U.S. and China. I, as a Chinese, live in United States. I try to, interpret this question from both sides. What current my plan is? I'm going to talk a little about what the current my plan is and what I'm going to do for the next step. So to handle or prepare for the recession, and I will talk about more details later. The current status I'm going to review, which is in short-term view, long-term view. We're gonna cover the CPI data, balance sheet, kind of technical analysis. So that's pretty much everything I have first. I'm going to talk about. Then I will. No, next time I will go through more details. All right. So first of all, I'm going to cover issue on some kind of details, which is which is the called inversion yield curve. So inverted yield curve currently has been discussed a lot, since this is kind of a risky event. That happens based on my experience. That happens 2 times before. One is 2000, year 2000, 1999. The other time is 2007. So when that happens, stock market tops and the recession happened in the following year. So here is. All right, so here we go. Here we go. So look at the chart on the left. You will see this, the yield rate from 3 months to 30 years. 3 months is more like short-term, lending. It's more about small business. It's more about the short-term investing. So I think this chart has been referenced for many people, and you can see that from stockcharts.com. You can find that from other websites. They'll have a similar rail here. The other side, the other side is a stock market performance for Standard & Poor's 500. You can see that from the 2000s, before 2000, you can see the yield is pretty flat. And the yield is pretty flat means that short term and long term is pretty equalized. That is definitely not a good sign. Well, we can see that then we go to for 2000, they just not say crash, but they go into a bear market, and the bear market actually that is about 2.5 years. So the correction is about 50% from 2000 to early 2003. So once you can see that the curve become the slope of curve become deeper, once the economy going down, so that become even better. So that's what I'm looking for. Actually, is looking for the curve from low to high, not just a curve to flat. So then you can see the economy can be recovered. Actually, the economy has been recovering in 2004, 2005, and then you can see the curve is pretty, the slope is pretty deep, and then you can see, until we have seen the flight happens in 2006. So 2006, we have seen the flight. Let's give them at that time. Then, if you remember the news, they give you the news is that that actually is very dangerous. So you see the very dangerous in 2006, and they have huge corrections happens in 2006, and then they have the final wave. I call the down wave. Is that all the money comes in and boosts the stock market, and then you can see the curve begin to begin to reverse, or maybe called yield curve inversion. So yield curve inversion means that the 3 months, even the yield rate for 3 months is higher than 30 years. That totally doesn't make sense because people, and now the borrowing money for business, and even compare the yield, nobody want to buy the short-term bonds. So that's not a good sign. Once we have seen not a good sign here, you can see ooh, and then stock market tops and flight, guang, and then crash. Once the stock market crash, you can see that and then the yield will become very different. You go back to this kind of form, and then economy going to really, really bad in 2009 and 2010, or even 2011. However, you can see that the curve is really healthy at that time. And then stock market actually is about 1 to 2 years ahead of economy. So it fully recovered from recession and going up. And then in 2012, we have seen that is European bond crisis, and still you can see the very health status go down. Then in 2013, a lot of people actually, I still remember people calling for crash. But actually, you can see based on the current bond yield, the bond market is very healthy, and there's no problem. But you can see, when QE1, QE2, and QE3, they keep printing a lot of money. You see that the curve actually become more flatter, because the 30 years, interest rate becomes really, really, really flat. And then until nowadays, you can see that really flat, and then something happens now today, which is that we have seen that something happens in the inversion yield curve again. So once the inversion curve happens, and normally stock market will go to the correction, a huge correction, and we have seen that huge correction, and then the economy will go to a recession. However, however, it's very hard to measure that how long it will be. But you can see that first in 2006 we have seen the inversion before. But then they still have a very, you can see here actually it's about 20 to 30%, 20% plus increase. And then go before actually we have seen that happens. So you can see happens there about another few months. Yeah, it's about a few months and go to crash. So the question is that how long it will be. Because that is pretty certain that most of people are very scared. The market will be crashed, and then recession is coming. We need to be really careful. We are really panicking. Actually, I don't really think that's gonna happen really soon. But you need to be prepared that may happen very soon, because from previous experience, one time happens about half year, another time happens within about 1 year and multiple months. So if that is the case, probably we need to be careful about the 2019 and the 2020. 2019 this year, at the end of this year, or 2020 gonna be extremely risky. So that's the problem we can find. That's a current observation we can find from current yield curve. So I think I have seen this chart. I've been referenced multiple times, and a lot of people actually are doing this. But this is not the only thing. We adjust what's going on there. We want to share another findings, which is one of the biggest uncertainties. So let me talk a little bit about the current status of economy, because we are currently experiencing something we never seen before. The economy actually depended on two sides. One is the fiscal policy, like tax policy, trading, by country level trading, investment, consuming, consumption, investment, government, investment. That is all about that's all about physical policies. So there's a physical policy. The other side actually is monetary policies, that how loose monetary policy we have, what the federal interest rate gonna be. In another word, means that how much money actually we have, and whether we have more money or have less money. So federal, in my personal opinion, I think the most powerful person in the United States should be the Federal Reserve Chair of Federal Reserve, because they have been control they have controlled the monetary policy for a long time. Actually, never been challenged on. Never been until now. Actually, until now, I've never been challenged before, and they can control the whole monetary policy. And for monetary policy for the United States, actually can influence the people from other countries as well. But for physical policy, even you're the president of the United States, you still will be challenged hugely, overwhelming by Congress, even by Supreme Court. So you will be challenged by all means. But here, from monetary policy perspective, their decision is extremely important. What I have observed is something really, really weird, which is that, but every time when Federal Reserve, they have officials, they have meetings, they normally have a very consistent view by each meeting. If they have changes their views, they only change a very minor, very minor way. So they will not change that dramatically, because they want to keep the monetary policy consistent and clear. So based on my experience, every time their changes should be small. For example, let us do maybe from June 2018 to maybe let us see from September 2018. You will see the average forecasting by their board members, officials, actually is pretty consistent. You can see the median is 2.375 and then 2.375. So actually the curve gonna be really consistent. So look at it, it's from here, September, June 20, June, and then we change to December, we have September to December. And December is 2.375, 2.375. So they have we call it the dot plot. The dot plot is really, really consistent. It's nothing, changed significantly. So you can see that probably, you can see based on this chart, you can see that, the interest rate become, their officials become a little bit more conservative. A little bit more conservative probably. But look at this, the most recent one. The most recent one is from December to March. For December, so we have a median is 3.75, but and in March actually become, you can see December is about 2.875. Now they become 2.375. So what does that mean? You can see here, the average here by the voting here for 2019 used to be, consistent, and before it's about, we're gonna increase interest rate from 2.5 to 2.75 or maybe 3. So maybe we're gonna increase interest rate to 1 to 3 times. However, after this meeting, they become lower by probably no interest rate hike to minus 0.5%. So if you go to this rate, if you go to see the Federal rate monitoring tool, currently it's 2.25 to 2.5, it's 93%. You can see there's no rate hike perspective, or maybe expected from watch rate. So people actually are expecting a lower interest rate in our rate reduction. And then the other side, talking about, called the balance sheet, tapering, and they stop doing this. So why? This will be the very, very question, which is that, what happens from Federal Reserve? They do from, consistent way to dramatic changes. That never happened before. Because when we do this, you from really, really aggressive to not really aggressive, but a relatively moderate aggressive to adding interest rate to down to even no rate hiking, and down. What's hell going on? So I don't know, because I think I personally think the previous Federal chair, maybe Mrs. Yellen, she should really increase the rate a little bit earlier, because since the economy is still growing really well, you can have more, reduce the balance sheet, and to keep, the to keep your weapon, to have your weapon to handle the potential recessions. She didn't do that, and now once they have new the chair of Federal Reserve, and Mr. Powell, and he increased interest rate dramatically. That is interesting. And now until March 2019, and he changed and turned around by 180 degrees. So at that day, actually, the market, was very, very happy and celebrating, just like a party, because the high interest rate definitely is the poison for the stock market, for the equity market. And now we turn to even potential lower interest rate, and we stop the tapering of the bond buying, tapering the bonds, the balance sheet. So currently, and at first few days, people are very happy and feel there's another party here. However, other few days, people thinking about what happened. What happened to our current economy? What happened to make Mr. Powell make this decision change so dramatically? My personal opinion is that that is definitely the disaster for this country and for the global economy. Because when you make decision, it's not the game, it's not a video game, it's not even the game for an enterprise. It's the game for monetary policy for the largest and strongest country in the world, and also strong influence to other countries' monetary policies. And you can change that almost 375 basic points in 3 months. That is not acceptable, to be honest. I feel this way. It's totally not acceptable, because that give you a really strong information is that we are in a big trouble. So that, from my personal opinion, I really think that it may create a lot of more chaos than expected. I don't really think that is a good thing at all. So we will see what's going to happen for the next. But so far, I don't really think that is the right decision he made. And definitely, either you don't need to raise your interest rate in December, but you did. You did raise your interest rate in December, but just keep relatively flat in March, but you dramatically turn it down. It's not a game, but currently, I think it's out of order. So we will see what's going to happen for the next. I have no idea why they made this decision, or if if I was the president of the United States, definitely I would not be happy, because we have dramatic changes in terms of monetary policy that will change. A lot of chain effect will happen, and will make a lot of uncertainties to the economy and the future of the country. And then for 2019 and 2020, we have presidential elections. Probably that will be another thing you need to consider. Okay, so that's the first thing we talk about, inverted yield curve. The next time I really want to talk a little about the trade war. So the current trade war is very popular, and people talking about the trade war, especially between India, not India, is the United States and China. The reason of that is we can talk a little about, which is that why there's a trade war, because after let me see that. So after this, you can see export. So we have a video from this. This is really cool. And then you can see the export data up here, for China in 1979. Let's go to a little bit later. You can see 1995. And remember, that is the year actually China entered the WTO, World Trade Organizations. And you can see the trading numbers from China actually increasing dramatically after 2000. You can see how crazily this number is increasing in terms of GDP and the total exports. So the total exports actually increasing too much, and then that creates the potential maybe competition, a lot of competitions to United States. And then you can see that sometimes from 2014 China has more export, and then United States catch up in 2016, and currently it will become very competitive environment, because currently both big countries are competing for who can export their products more. I remember at first China's export always like twice basic products, clothes, all this kind of stuff. But the current competition is based on cell phone, computer, even cars, automobiles, and then high-tech products. So the competition become everywhere, but for the next generation or maybe next 10 years, I think the world market, will be more competitive. And then if you are the president of United States, probably you're gonna think about the war as well, the trading war as well, because you want to compete and you want to hold all your shares, you hold your interest. But from China's perspective, I think it's not a bad thing as well. Since United States push a lot of pressure on China, and then I pretty believe that this is the opportunity for China to re-innovate and to change the type of industry from very basic materials, toys, this kind of stuff, to very high-tech stuff. So that is another thing we're going to talk about, the trade war. Another reason to trigger the trade war is for the future. So the talking about the future is that I personally believe that there are three things we need to pay attention for the future status. One is the 5G. So 5G is definitely the life-changing, the revolutionary technology for the next century. Like the industrial revolution, electrical revolution, information technology revolution, and 5G will significantly change our life. Plus, because 5G can create a lot of data, all your behavior, all your almost everything will be tracked, and you have a lot of data, and you can, the change will be dramatically, and then your life will be dramatically changes. I would like to say that the currently 5G is the one of the biggest thing in the future. And the second thing I think is about a new material. So the new material we have seen for the electric cars, for some new material for building the different manufacturer products. Then it will be the competition again. So the new material, 5G, and I think either blockchain, we call it artificial intelligence, all this kind of technology stuff, will be the battleground for big countries, especially for United States and China. So that's why we have seen a lot of topics, news talk about the next step. Then I want to talk a little about potential issues from China. Actually talk about real estate bubble. We talk a lot about this kind of things, but actually from my personal perspective, I think the biggest the risk actually is in terms of population. The population actually will be topped in 2035 from this website, but I think this number actually is still a little bit too conservative, or probably the number going down so quicker. Just because you can see that we have seen a lot of more senior people, and then very, very smaller young people. So compared to United States, You can see the United States is more healthy. You can see that more young people, and you can see it's relatively equally distributed. Same problem for almost all the Asian countries. The population has been decreasing. If you go to see Mexico, you can see their population actually is shrinking in maybe next few I don't know how many years, but currently there's still expanding. Still expanding. And look at India, so yeah, you can see India is here. The population is still expanding. So that is the population is definitely the key factor for economy goals. So from my perspective, I'm be set up very near term, maybe 20 years, regarding to either technology, trading war, market share for the whole world, energy resources, all these kind of things. I'm personally really worried about is about the birth rate. The birth rate from China, actually from Japan, is incredibly low. It's incredibly because Japan here is incredibly low. I think that will be the biggest impact for all kind of market. All right. So before we go to next, I will take up. I will. Okay, I'm going to talk about the second. Talk about some long-term, short-term chart in next session. All right, welcome back. And then the second section, we are going to talk a little bit about technical analysis of the trend. The first thing I want to talk a little about is U.S. dollars. For the last 10 years, we can see U.S. dollar actually become a range play. Is some 103 U.S. index is almost topped, and then it's just like consolidation for a long time. But currently, if you look at their structure, is kind of weak. Because you can see that even couldn't reach 101. So actually, it's just like consolidation work between 92, 93 to 98. Between 92, 93 to 98. And then here is, we have a push down failure in 88. So there is a consolidation of a push down failure in here. And that means that, probably, and we have a safe or maybe another consolidation period for another 1.5 years. So for US dollar, if US dollar couldn't go, I don't believe if I was a president, I probably don't want US dollar go up so fast, especially when CPI currently is very low, and I try to push US dollar to as cheap as possible. We can do the higher export products, selling more maybe airplanes, right, and then selling more US made product, and as well as reduce the cost for a lot of stuff in terms of lower our US dollars. So that's why US dollars, that is tricky part. And here I think the strong support is on about 92.83. I will see what's gonna happen for the next step. But currently US dollar is pretty weak. I don't really think US dollar I don't believe the US dollar is kind of opportunity here. Probably if we need to observe that if we break down by 92, 93 this area, probably they're gonna be lower than 88. So if US dollar crash and going down a lot, probably people and investors lost their confidence of the United States. That will be another bad sign for the United States. We will see. Back to another chart, which is Russell 2000. We have seen huge consolidation before, and see from last many years. And this time you can see here is a structure we have seen, which is the shoulder, head, and shoulders. We have head here, which is topped. We can still call them topped, or maybe we can top them as a fake breakthrough, or maybe breakthrough failure. And here is the bottleneck. Here is the neckline. The neckline here is around 15, 14, 17, 500. So this one is area. So if that one is going down and push down again, probably we'll see a serious correction, even lower than 1266. However, we can see a huge wave come down first for as a wave 1 and then come up and then maybe come down this way, and also there is called push down failure as well. If we can still going up and break through here and clear here, I'm pretty sure that if something just like this happens, there is another huge wave of you can see here it's still like the left shoulder, red shoulder, but they break through, and then there's another consolidator, then it goes up a lot. So we will see. Actually, we couldn't make a decision now. Is that maybe 70% or maybe 60% like going down based on what we just described, and then maybe have a 30% going up. So we will see. Actually, it's hard to say that currently. Hard to say whether it's good or not. For long term, we can see same pattern for Standard & Poor's 500 index. Currently, we are in a very risk area. Short term still bullish, but for long term, you need to be cautious because I don't know what's gonna happen for the next step. But currently on the resistance. So NYA same thing. Let us do it again. So index here. So let me do this right now. Since we have a lot of bad news, but we know that once the inverted, the yield curve happens, there's not going to happen, the recession not going to happen or come in really, really quickly. Especially they still have a lot of fiscal policy they can do, and they still have, technology innovation. So I don't really want to be so pathetic. Think about, everything's gonna be bad. No, I don't really want to see this way. I try to be hopeful, and try to be hopeful and think about, current trend here for like the index still very strong. It's still very strong. Probably here is the resistance. So let us see that whether they can hold on here as now because it's on the resistance part, and whether we're still going up and whether how long we can go up. So we will see if we are seeing a huge down like this, and probably we need to be really, really careful. But if you don't, actually so far we don't need to be so bad, so worry so much about that. We still have a lot of time to see what's gonna happen for the next step. So don't need to be panicked because no necessary. But the risk has been increased dramatically. Another way is you can see China's stock market has been going up crazy. So that happens every few years. So I do really believe that there'll be another opportunity in the emerging market, especially China market, for this year or for the next few years. So we have to say that every time the global phase, global economy, we have to make sure everyone will come in. So you can see wave B, C, 3 waves. And currently, I think probably this is best opportunity to invest here. We will see how long it will go. So long story short, let me go back to our basic. The basic is that we have seen you don't need to worry about from recent days. Totally no need to worry about for everything. However, we have seen the risk, uncertainty has been increasing dramatically from recent 2 years or 3 years. In 2008, I think it is really great because the correction happens so fast. 50% downturn, just like about few months or 10 months. And then economy quickly recovers. Two things happens. One is fiscal policy. China has spent 400 billion or something, or even more in infrastructures. So means that they bought a lot of steels, materials, and hold the price for the economy to boost the economy for the last 10 years. But currently, you can see the overheat, the infrastructures, too many airport highways have been built in China. So economy developed so well, but the question is that what else they can do. The second, the reason for second part is the monetary policy, from Federal Reserve and Bernanke created, quantitative easing that helps the economy boost. But after that, you can see the balance sheet from all the central banks are really, really high. I have no idea what they're going to do for the next step, but I'm pretty sure that for next downturn probably will be a little bit painful. The painful probably not just like crush so quickly because our interest rate is still very low, still can hold that in a price. And I really don't believe that stock market is really overheated like crazy. But we can see that they will become weaker and weaker. So I'm not so optimistic just because I'm thinking for the next step. Probably is economy going downturn will more like 2000 to 2003 instead of like 2007 to 2008 because currently we have too much money on the market and the economy is still strong, but they're going to be weaker and weaker. But the question is that they're going to go weak slower. So then maybe the bad thing is that the bad time will hold, or the winter will hold a long time. So the winter will be longer, and you need to be prepared. So from our personal perspective, I think we need to prepare more in terms of, even everything is fine, everything will be fine. We still have all the the prosperities, and we don't have any issues. The economy is so strong, but there's no harm and nothing will be hurt. When you think about just if that happens, what are you gonna do? What are you gonna do for living, and what are you gonna do for life, and how much you prepared? I think I'm the person to believe cycling means that we all live in a world with tons of cycle. You cannot hold for bull market forever. You must have a bear that's gonna be really healthy, good for the market. We are all in the cycle, just like four seasons. You have winter, definitely have summer. So if you have overheat, probably will go cooler, and then you cooler, and then go to so cold, and it'll get warmer. So we all doing the business, like business, our countries, we all do that like cycle. So we have cycles here. So you can avoid, the recession or downturn happens, never happens. So we all go upturn. So this is really normal. But the question is that how long it will take, and what are you gonna do for next? So I would rather to save more for my savings because every time when economy goes so badly and the stock market, the equity market become extremely cheap, and then that will be a great opportunity to buy and to get a really cheap stocks and cheap index and make a lot of money. And then go the other side. After 2 to 3 years in real estate, all this kind of real estate market, they go to the bottom point. So just like 2008, the real estate market crashed. But the lowest price happened in 2017. So you have 2 to 3 years gap to make some money for stock market, to make money for real estate market. So, but at that time, you need to make sure that you have your bullets, you have your money in your hand. Make sure that you still have your power to change your life. So we call it a life-changing event. So we will see the life-changing event maybe coming in next 1 to 2 years, or maybe 2 to 3 years. So who knows? Nobody knows what's gonna happen. We don't have a crystal ball, but that's gonna happen sooner or later. So my suggestion or my personal feeling is that probably I need to save a little bit more, for the next one. Even you save a lot of money, you say, oh, I just want to consume, I don't want to make more consumption. But during the recession period, you can see everything is much cheaper. If you go to traveling, everything will, is super, super cheap. They have a lot of, like even airline tickets super cheap, the hotel super cheap. So you still saving a little bit more now and being more conservative. is not a bad idea. So if in terms of our personal investment, I currently shift to a relatively conservative approach. I try to keep more cash in my hand, not so aggressively invest for one stock or one index, and waiting for even more meaningful corrections. So we will see. That's pretty much everything I have for today. And if you have any questions, please feel free to let me know. I'm happy to discuss with you. And good luck for your future, good luck for your career, and good luck for your trading. And I really hope my 2 cents at least can give you a very different view, or maybe I don't know whether good view, bad view, whatever. If you like it, let me know. If you don't like it, totally fine. Let me know as well. Let me stop here, and if you want to hear more, probably we can plan for the next session. Thank you so much. Bye.